Hello, everybody, and welcome to today's webinar and discussion about retirement. Oh my goodness, this could not have come at a better time for me because I've only really recently in the last couple of years really started thinking about retirement and what that means and how I'm going to save for it. So I have a whole lot of questions about it. I'm really new in this space. For those of you who don't know me, my name is Carly Barnes. I'm the relationship manager at EasyEquities, but I'm a huge SATRIX fan. In fact, a lot of SATRIX is what's going to get me to retirement. That's my plan. If you are, well, you are all SATRIX clients or part of the SATRIX community. And so, yeah, we're going to be talking today a bit about the products that you can use to get you to retirement, what an RA means, what a TFSA means, and a whole lot of other stuff. But I can't do this on my own. I'm bringing in some heavyweights to help us with the more technical questions and some broader financial information. So I'm going to introduce you guys to them right now. The first joining me, the first heavyweight in our lineup is a lady by the name of Candice Paine. She is an independent financial advisor with 20 years of experience in the financial services industry. She's a strategy consultant and she's going to bring a wealth of knowledge on all the SATRIX products and retirement in general. So thank you so much. Welcome, Candice. Thank you for joining us.
Thanks for having me, Carly.
Great. And then we've got another sidekick in the mix here. I've got Craig Turton from the Purple Group, who heads up the wealth team there. But before that, Craig has been in financial planning for like 18 years, and he's super passionate about it. So Craig, so excited to have you part of this conversation as well.
Thank you, Carly. It's great to be here. Hey, Candice.
Hey, Craig. Good luck.
Yeah, you too. Take it easy on us, Carly.
Always. That's how I roll. So I think we should kick things off with a bit of a poll to get a sense of where everyone's at the moment, because everyone's at a different phase in their life. Everyone kind of has different ideas about retirement. So I think let's kick off with a bit of a poll and get a sense for where you guys are at. So you should be seeing a poll appear on your screen right about now. Please go participate in it, take a look at it, give your response. I'll read out the questions for you if you like. So the first one is, I have started saving for retirement. The second one is, I don't know where to start saving for retirement. The third one is, I don't think it's necessary to save for retirement. And the fourth one is, I'll start saving when I'm a bit older. And I can definitely tell you guys that I was part of the fourth category for a very long time. I was like, retirement, it's something I'll worry about when I'm older, when I'm learning so much more now that, yeah, maybe it's something I should have been thinking about when I was a lot younger. So I see a lot of you guys are filling out the poll. It looks like we're almost at about 80%. So yeah, I think let's give it another few minutes or another minute or so. But I'm seeing a frontline winner. I'm seeing a frontline winner, and it's quite good news. So yeah, I think let's go ahead and share these results and see what you guys think about it. Results should be coming up shortly. Okay. So guys, you should be able to see the results in front of you now, and we can see that sort of runaway winner, which is great to see, is that majority of people have started saving for retirement. What do you guys think about that, Candice and Craig? Does that make you happy?
Very.
I'm very surprised by it, Carly, I must say. Yeah, I was probably had money on number 3 and number 4, to be a majority of it. So yeah, it's amazing. It's excellent. Sure.
And then the second one with only 10% saying, I don't know where to start saving for retirement. So I think some people, and maybe a lot of you on this call, are wanting to kind of get a bit of guidance in that respect, because I think there's just so many options out there. There's different vehicles on how to save for your retirement. There's obviously your own personal style, your own risk appetite. There's quite a lot of things to consider. So I think that's great, because we're going to be addressing some of that stuff today. And then only 1% don't think it's necessary to save for retirement. And also think they'll start when they're a bit older. So we're going to convert you guys today. So yeah, thanks so much for that very interesting poll. We can go ahead and close that now. Okay, great. So I'm going to start at the beginning because I'm at the beginning sort of my retirement kind of journey. There are lots of ways that you can start saving for your retirement, but I think the first thing that pops into everyone's mind is a retirement annuity because it's in the wording, right? It makes sense. So I don't know, Craig, maybe you could just unpack for us, what is a retirement annuity? How does it work? Just a very, very kind of general explanation.
Cool. So yeah, I like the way you broke it down there. So, just the word retirement annuity. So very obviously focused on retirement. So it's a long-term investment vehicle. And then the word annuity.
Okay, maybe we can just leave Craig for a second. I think he's taking a moment to think about it. Candice, maybe you can jump in there. Obviously, a retirement annuity is a way to save for retirement. What sort of, in terms of SATRIX, how does that translate to SATRIX? What sort of products or funds are available within the retirement annuity space?
So you're correct. It's a product that you can save for retirement. You start saving from as young as you possibly can, up until age 55, which is when you can start drawing. There are restrictions on what you can save in a retirement annuity, Carly. So we have something called Regulation 28 in South Africa, which regulates what you can save for in pension fund vehicles. It's a whole lot of jargon, but basically it means you can look for a fund that has a maximum of 75% in equity, so that's shares listed on the stock market, and the other 25% broadly needs to be in money market or bonds or property stocks. So those are the sort of restrictions, and we can have a conversation around whether the restrictions are good, bad, or indifferent. But I think the point with the retirement savings is that you just start, because it's the compounding that is so powerful when saving, whether you're saving for retirement or any other long-term saving. It's kind of start as early as you can, get as much into the product as early as you can, and then let it grow, making sure that you've chosen the right underlying products.
So I am a SATRIX client. I log into my app or the website. I have my normal SATRIX account. I have a tax-free savings account. And then if I want a retirement annuity account, I can actually add that onto my SATRIX profile. So guys, if you're in the app, you can scroll down and you'll see there's a little plus sign that you can push, and you can then add additional accounts, which is really cool. So if you're someone who wants a retirement annuity account, boom, you can just add it just like that. So I add it. And then one of the things you have to do is you have to select a beneficiary. And I understand that that's because, if something were to happen to you, you need to have someone who can actually get that retirement annuity, say, for example, if you had to pass away. So it's really necessary and important to put that information in as part of setting up your RA account. But once that's done and you've got your RA account, then let's maybe talk about the available funds within the RA that you can invest in. I mean, there's probably a few different options. Maybe you could talk us through what those are. You've spoken about Reg 28. One of the things when you, or collective investment schemes, one of the things that I wanted to comment on is this sort of a way that we make sure, or that I guess regulation makes sure that these investments aren't too high risk, because no one wants to lose the entire retirement, right? Is that one of the reasons for that regulation?
Yeah, that is exactly the reasons for the regulation. But even within the sort of ambit of the regulation, you can still choose a risk profiled fund. So what SATRIX has on SATRIX now in their retirement plan are two different unit trust funds. One is the SATRIX Balanced Fund and one is the SATRIX Low Equity Fund. And the real difference between the two of them is how much equity or how much stock market exposure you have. Because stock market exposure is what brings risk to your investment, but it's also what brings growth to your investment. So if you're taking on higher risk, you need to have more time. So the younger you've started saving for retirement, the more risk you can take on. So if you're very young, you start with the balanced fund. It has a maximum of 70% in equities, and that's a little bit of offshore and onshore, local equities as well. Whereas your low equity fund is more in the order of about 35%. So you can see that the very different risk profiles, but both of them are suitable for your retirement annuity. We also have the money market fund available for your retirement plan, but I would guard against people saving long-term in the money market. It really is a place to park funds, or if you feel that the market is really volatile, to kind of move some of your money into it. But over long periods of time, your money market isn't going to beat inflation. And remember, the first hurdle with investing is to beat inflation. That's the first hurdle. After that, you want compounding, and that's where the wealth creation happens. So yes, there are two choices to choose from, and they're quite simple, lots of detail in the app.
Okay, amazing. So now let's look at what we've got here. We've got retirement annuity, which we've touched on now. And I think it's worth unpacking a little bit more about a retirement annuity, but I think it's also good to do that if we compare it to the other options. So if we look at an RA, this is a tax-free savings account, and maybe we touch on, you've spoken about money market now, but that's also in the mix. Craig, welcome back. That question must have been very difficult. You had to go away and think about it for a while. It's fine. We've got another one for you.
Load shedding. How's that? Really sorry about that. Yeah,
that's okay. Here we are. We're rolling with the punches. So let's get into a bit about. Me and Candice have just been talking about an RA, the different funds that are available on SATRIX in the RA space, and a bit about money market, about how it's not really going to beat inflation. And so, investing, your aim is to beat inflation. So it shouldn't really maybe be considered as your retirement strategy, but could be a soft place to fall if the market's really volatile. That's sort of what we've been discussing. But I think in order to explain an RA a bit better, and this is a question we get a lot actually, is what is the difference between an RA and a tax-free savings account when it comes to saving for retirement? And there's a couple of things to think about there. Who's best suited for either? Is there a person that's better suited to one or the other? What are the costs? How does that compare? And how does tax work with both of those? Because they work a little bit differently. So let's start with you, Craig, and Candice, you're also welcome to give your input as well.
Okay, cool. Yeah, cool. So I think, before we unpack the technical differences between a tax-free savings and an RA, I think for me it's quite important for investors to realize that there isn't one that's better than the other. So it's not an RA versus a TFSA. They actually complement each other really well. So I think when you're looking at your investment portfolio, rather decide on what's the best combination, what's the best way that you can utilize both investment structures, because they both have huge benefits in different ways. So they just need to be taken into consideration when you're looking at your financial portfolio. I think that the biggest thing for me in terms of the difference between an RA and a TFSA is liquidity or flexibility. So the nice thing in a way is that you can access money in a tax-free savings, whereas with the retirement annuity, you're kind of stuck in there until you get to at least age 55. So I think some investors see that as a bit of a hindrance to want to invest in it. I personally see it as a good thing, because I use the RA to save myself from myself, essentially. It prevents you from
keep your hand out the cookie jar.
Exactly. So it just forces you to save for that long term. And I did a survey actually within our company a little while ago to ask people who had accessed their tax-free savings that they had in place. And it was over 90% of the people had accessed their tax-free savings. So, and I think Candice will chat on that a little bit later, but if, as soon as you start accessing and withdrawing money in your accumulation phase or the creation phase, you're just kind of destroying value there, So I think, I think it's a combination of the two. They both grow tax-free, once you're inside it, which is really, really cool. So from that point of view, if you're looking for tax-free growth, either one of them is really lacquer. The other big difference then is that with the retirement annuity, you actually get a tax deduction on the money that you're investing into the RA, whereas a TFSA, you don't. So what that does is it basically saves you tax, by investing in the retirement annuity. So you pay less tax on your monthly income based on the contributions that you made to your RA.
So that's, let me see if I get the terminology right. An RA is a before tax event and a TFSA is an after tax event.
100%.
Transaction.
Yes.
Okay.
Yeah.
Can I get some tax money back in my tax return if I have an RA? I know a lot of people do that, and I've always wondered how. I want in on that.
We all hate paying tax, eh?
No one likes it. No one likes it.
Yeah. Okay. So with an RA, yes, completely. So maybe if we can just look at a simple example. Maybe example is the best way to do it. So if you earn, let's say, 200,000 Rand a year, okay, and you decide that you're going to contribute 15% of your salary to the RA, which is 30 grand, okay. So what happens there is that you've now paid income tax on 200,000 Rand, okay. Then you've contributed 30,000 Rand to your RA. So when you do your tax return at the end of the tax year, SARS is going to see, okay, I've contributed 30,000 Rand to the RA, so I'm only going to tax this lady on 170,000 Rand instead of 200,000 Rand. So then you're going to get a rebate. You're going to get a refund back from SARS because they've taxed you too much because of your contributions towards your retirement annuity. So it brings down your income tax payable at the end of every year.
Fantastic. I love that. Okay, so the other aspect I think we want to touch on, and maybe Candice, you can jump in here if you like, is just about costs. Some people may have the idea that maybe because within an RA, the funds are a bit more managed, so there's more fees there, whereas in a TFSA, that's not the case. What sort of cost comparison should one do when considering those different vehicles?
So there are going to be two costs that you pay on the vehicles. For the retirement plan, you're paying an admin fee for the retirement plan, and then you're paying a management fee for the underlying fund that you choose. And in total, that's in the order of about 0.65%. In your tax-free, you'll also pay a platform fee on SATRIX now. It's a sliding scale, so the more that's in there, the lower your fee. And then usually with what happens with the tax-free is you'll be investing in ETFs. So there's a brokerage fee to buy into the ETF. There is obviously a management fee in the ETF. But with your tax-free, we're looking for buy and hold. I wouldn't really be recommending that you're trading in your tax-free account because you're viewing it as a long-term investment as well. So I think Craig touched on that the RA you can access at age 55. Your tax-free, if you stick to the principles of it, which is 36,000 Rand a year, up to a lifetime maximum of 500,000, it's going to take you 15 odd years to reach your lifetime maximum. So both of them need to be viewed as long-term investment vehicles. And on SATRIX now, as on EasyEquities, the costs are extremely low. So if you're trying to compare that to, we've had some questions come in around life insurance company or other asset managers, you're arguably not going to beat the costs on SATRIX now, currently.
Cheap, affordable retirement investing. I like it. Sounds like a plan. Okay, guys. So we've got a couple of other things that we wanted to touch on today. We've spoken about tax-free savings. We've spoken about RA. I'm gonna ask a selfish question for just me. I've only recently started, right? I've only recently, probably in the last 2 years, started saving towards my retirement. I'm using my tax-free savings account and an RA, actually, so 10 points for me. But Candice, tell me about the impact of time and age and when you start these things, because I want to talk about investing for your kids and setting up retirement annuities for your kids and stuff like that. But I think it's quite powerful to look at in terms of just visually on a graph or something, what difference it makes if I had started investing 10 years ago. Don't depress me too much, but if there's something that you can speak to about that.
Okay, Connie, I'm going to share a graph that we got together a little bit earlier. Tell me if you can see that up on the screen.
I can see it.
Okay, so what this graph is showing you is when these three individuals started saving and when they stopped saving and how long they left their savings to grow, which are all things that are within your control as an investor. So time is your friend. It's time in the market. And as I mentioned before, getting as much money into your product as early as possible so that you can benefit from compounding. So let's look at Susan. I'm very aware that these numbers are in dollars, but just take the dollar sign off and put the rand one there. So Susan invests 5,000 rand annually between the ages of 25 and 35. So if you look along the bottom axis, you can see the time period that she saved for, which is 10 years. So in total, she saved 50,000 rand, and then she stopped, but she left the money invested. Let's compare that to Bill, which is the green line. He only starts saving at age 35, and he saves from 35 all the way to 65. He's saving 5,000 annually, and he puts in a total of 150,000. So if you can compare Susan and Bill, Susan's still way better off because she has longer time in the market. It's this compounding in the early years that really, really make a difference. And then we look at Chris. He's the hardcore saver. So he saves 5,000 rand from age 25 all the way to 65. So this is in the savings industry, we want more Chris's. Everyone starts really early and keeps going until age 65. He saves a total of 200,000 rand. And you can see he is multiples ahead of the other two. So he has benefited from the early compounding, and he has benefited from adding to his investment for the longest period of time. So these are the things that you need to think about when you're saving for retirement, and especially very few of you tick the box, I'm gonna start saving when I'm older. That's not the way to do it. You need to start saving really young because it's compounding. That is the magic in the market.
Thanks, Candice. Now that Chris has made us all feel bad about our lives, but it's also never too late. You know, there's still growth to happen no matter when you start saving. And then obviously that's when it comes down to looking at the products and which risk level is the right one to suit where you're at. So thanks so much for sharing that. We can take that down now. I think that's a good segue into a conversation about kids. Craig, you've got kids. What are you doing for their retirement? What is a good strategy for saving for your kids? And also, is there, someone's actually asked a question here, which I thought was related to this. Is there a good investment vehicle or education to save for kids' education? Would that come into this at all? Probably not.
Yeah, well, so I think the first thing there when it comes to kids is as a parent, what are you investing or what are you saving for? So I mean, I asked myself that question. So are you putting money away every month to fund their varsity when they get to 18 years old? Are you investing every month to provide them some capital when they get to 24, 25 so that they can afford, you know, maybe a deposit on a house, you know, maybe they want to travel somewhere. So then the third one could be, I'm putting this money away, maybe during high school varsity years, they've got a school trip that they need to go on. That's going to cost a few thousand rand. And I'm going to dig into that fund, you know, to assist, you know, with those expenses. So it's almost a way of saving for those lump sum costs that your kids are going to go through, you know, during their, whether it's school or university years. So I'd say a TFSA is a good education tool. I personally use just a normal SATRIX investment account for my two kiddos. I mean, Tristan's 9, just about to turn 10, and Kaylee's 6. And, you know, we started those investments when they, you know, literally the month that they were born in. And what we do is we try and encourage, because I'm a nerdy kind of investor, I try to encourage friends and family, more family than anything else, to actually, you know, rather, you know, gift them 100 rand or 200 rand, and then I just put that into their SATRIX investments, you know, rather than, you know, a toy or something that they're going to forget about one day. So, you know, it's grown nicely over time. So there's the option, TFSA or a normal investment plan. I wouldn't do an RA, you know, for a child. I mean, they're going to benefit from it massively down the line when they get to 55 or 60. But, you know, that's really long term for them, you know, and, you know, they need to save for their own retirement at the end of the day. So yeah, I would go the tax-free route, if not the RA, if I was some parents thinking of that out there. Hey?
Yeah, and once they've got that foundation, having learnt that growing up, when they do start working, they'll understand the value of that saving, and that's when they can set up their own RA.
100%, 100%. I mean, with Tristan, my eldest, I started having those sort of money conversations with him, and talking about how his, SATRIX investment is diversified. So he's in the top 40, and he's also got the MSCI World ETF, and we chat. There he's got money invested overseas, which he says is like really, really cool. I wonder how many of his friends have that. And I think that's just good planning for them as well, to have some, overseas diversity, with a 9-year-old.
Yeah, definitely. He's the coolest kid in school, basically.
I think so too. Yeah.
Okay, so let's look at a different scenario, because we've been speaking about contributing from as young as possible, consistently taking advantage of compound interest in the markets. But Candice, what happens if you just one day get a lump sum of cash? What if you get an inheritance or some big amount of cash and you want to then put that towards your retirement goals? What's the best way to kind of use that in your favor?
So it depends on how big it is, because remember, there are limits to what you can contribute to both your retirement annuity and to your tax-free savings account. And I just, Carly, before I move on, just wanted to touch on the tax that you're saving. I'm not sure everyone's kind of up to speed on what is the actual tax you're saving. So with your retirement annuity, you save on the income tax upfront, as Craig explained to us. On the growth in both your tax-free and your retirement annuity, you save on the capital gains tax. So that's the gain on shares. So if you buy a share for 100 Rand and it goes up to 150 Rand, the gain is 50 Rand, but you're taxed on that. In your tax-free saving and your RA, you don't pay tax on that. You pay tax on interest income. So interest you earn, you pay tax on. None of that in your RA and your TFSA. And the dividend withholding tax is also tax-free. So it's a great savings to take advantage of. Now, with the lump sum, remember, you've got limits to your tax-free savings account. It's 36,000 Rand a year only. Do not put 1 cent more into it, because you will be penalized to the tune of 40%. So you could put some of your lump sum into your tax-free. With your retirement annuity, the amount that contributes to the income tax benefit, so stick with me here, is 27.5% of your taxable income. That's the maximum that you can contribute to your retirement annuity in a year to get that taxable benefit. You can over contribute, but you're not going to get the benefit from it until way into retirement. So if you still have money left over from your lump sum after you've topped up both of those, you can then just start saving in a flexible investment account. So I think the thing to think about into retirement is that you don't only have to save in retirement vehicles for retirement. You can save in very many different ways. So remember, your retirement annuity has restrictions on what you can invest in. So it's Regulation 28 funds. Your tax-free, as Craig touched on, you can invest in a myriad of things. And the portfolio he has for his boy child is fantastic, the top 40 and the MSCI. So that's a bit of local, bit of global. But there are a whole bunch of ETFs and unit trusts that you could invest the balance of the lump sum in to complement your risk profile, to complement your exposure, and make sure that your total portfolio, not just the individual products that you owned, are exposed the way that you want them to be. So last year, when the Rand wasn't as strong as it is, everybody was wanting to be offshore, and they realized within their retirement annuity, there was a restriction. They could only invest 30% of that retirement annuity offshore. So if you wanted to beef up the offshore exposure in your total portfolio, you would be doing it in that flexible investment, or you'd be doing it in the tax-free, where there are very little restrictions on how you can invest. So that's kind of the way to think about your whole pool holistically, everything that you've got, and look at the exposure on a see-through basis.
Okay, that makes me so excited. I just want to go and review all my stuff again and have a look at it in a bit more of a holistic way. Like you said, that makes so much sense. Something that people have been asking as well, because you've got these plans for growth and your retirement, but there's also stuff that happens in your life right now. So what are your guys' thoughts on an emergency fund? Like, where's the best place to put that? Is it a tax-free savings account? Is it a money market account? Because that's money that you sort of want to be able to easily access if you need it in an emergency. Craig, I don't know if you have some thoughts there.
Yeah, for sure. Definitely not a tax-free. The whole benefit around a tax-free is that the real tax benefit only kicks in towards the end. So you want to keep that money invested in your tax-free for as long as you can. But good financial planning is to make sure you've got that separate emergency account that's going to hold at least 3 to 6 months worth of monthly expenses in a cash account that's in a money market fund that you can access tomorrow. Your set of tires goes, you need to replace those, you need a couple of grand, you need something for school, you need something for work, whatever it is, you want access to that cash straight away. You don't want it to be exposed to the markets where it could drop, a couple of percent in the short term. So you just want to keep it in a money market account, 3 to 6 months worth of expenses. And know that money is not going to grow like your other investments, but it's there serving a purpose. It's there for your emergencies. And once you get to that six months worth of expenses, then start looking at investing in your RA and tax-free savings and things like that. Emergency account, very important.
Maybe I can just jump in there as well. Bit of a savings hack is keep your emergency fund. If you have a mortgage or a bond and you're paying off your house, keep your emergency fund in your bond if it's an access bond, because then you're saving on the interest that you're paying as well. So that's kind of a way to think about saving money as well as saving interest.
That's very clever. I like that idea, actually, because you're trying to get the best squeeze for your efforts, right? You're trying to get the best out of it. So that's a really cool, efficient way to do that. Very nice. Yeah. Okay, guys, we've got quite a few questions. So I want to just take a look at some of the questions from our listeners and our audience and see if we can address those before we wrap things up. So I'm going to just take a look here and see what people have asked. Okay, let's go with Setu's question. My employer already invests about 15% of my salary each month in the company RA. Why would I create an additional RA? And how do I know that it's a better fund than my current employer's RA? Any thoughts on that?
Yeah, so I think if you have an employee pension fund and it's compulsory and you have to be saving towards it, what you probably want to do is maximize that savings, because the first benefit is that you get the tax saving monthly. So Craig explained to us that if you contribute to your retirement annuity, you only get that tax back at the end of the year. What you can do also with your employer or through your HR is to find out who's managing the underlying assets in the pension fund and find out where it's invested. And that way you can do a comparison. Where the retirement annuity comes in is that it really was set up for people who are self-employed or who are not contributing to an employee pension fund, or who feel like they're not contributing enough to an employer's pension fund. So it really is a top-up. So they'll be contributing to their retirement annuity and the employee pension fund. But remember, the total of those contributions is 27.5% of your taxable income. Now, the benefit for saving in different retirement vehicles is that, and this is a long time down the line, is that when you get to retirement, that magical 55, when you can access these things, you can mature them at different stages. So some can still be growing, some can still be growing tax-free, and you've matured the other ones. So their benefits, it gets quite technical, I'm sure Craig will back me up on this, but their benefits to having more than one sort of pension fund when you get to retirement. But if your employee's pension fund is great and the underlying investment is good and you're contributing enough, stick with it. Don't move.
Okay,
Cool. If I can jump in there?
Yeah, go for it.
Cool. I mean, that's, spot on. 100% agree with Candice. And I think the big thing that we can all do in our pension funds at work is to check that underlying investment and make sure that it suits you where you are. I mean, I've seen countless clients who are invested in a money market fund, and Candice touched on it earlier. So if anything from this webinar, go and check where your money is invested and make sure that you're getting, that above inflation return, over the longer term. Don't be in a money market fund with them, because often that's a default sort of setting. If you haven't selected one when you started there, often they put you in cash and you forget about it. And I mean, I had a client who was in money market fund for over 30 years. And he retired with 3.5 million rand, and he was happy he could retire. But imagine if he was just in something that was yielding, a 10 or 12% return over that period, he would have had quadruple what he had. So it's a very, very small thing that can make a massive difference.
Yeah, good point, Craig.
Okay, the next question we have, which I also don't know the answer to, is what is a living annuity? If I get this product and die before I make a withdrawal, can the balance be given to my child? What
Yeah.
is a living annuity?
Yeah. Should I jump in there? Yeah.
Yeah.
So living annuity is, when you retire, your retirement funds are going to be converted. Well, one of the options is a living annuity. Another one is a compulsory annuity. But yeah, that's for another discussion. But so living annuity is the investment vehicle that's going to pay you a monthly income. So you're going to be contributing to this RA for 30 years or your pension fund. You're going to retire at 65 and you're going to move all that money into a living annuity. And then you're going to decide how much am I going to withdraw from this? The range is 2.5% up to 17.5% a year that you can draw from this living annuity. And then that's just going to provide you with monthly income over time. And then the nice thing about a living annuity as compared to some of the other products is that you do have beneficiaries on it. So your spouse and your kids or whoever it is will benefit from the living annuity if you did pass away. It doesn't get lost.
Okay, cool. Can you transfer from a normal unit trust to an RA and avoid capital gains tax when you do the transfer? Or is that considered selling and therefore attracts capital gains tax?
Yes, that one. You have to sell it, pay the capital gains tax, and then reinvest in the retirement annuity. But remember, there is an annual 40,000 Rand capital gains tax exemption. So the first 40,000 Rand that you've made will be tax-free. So you can have a look at that. You can also do something called tax harvesting. So your tax year is from March to Feb. You could sell some of it to the max of the 40,000 Rand, and then in the next year, sell the rest of it. So you keep using that 40,000 Rand exemption, that sort of capital gains tax-free portion, and move your money that way as well.
There's all these tricks that I'm learning. Robert wants to know what percentage of one's salary should you be saving every month to retire comfortably? Would 16% be enough?
Yeah, I think, Carls, I think that's all kind of relative. Hey? I think it depends on your whole picture. Hey? So it depends on how much debt you've got, depends on kids, it depends on your age. When you started investing, were you early, were you a little bit late? So generally, if you start an employer with a pension fund, you're going to probably go in at about a 15% contribution rate, which, maybe for 30, 35 years will be okay. But it's worthwhile, doing a little future value calculation just to see, okay, how much am I going to be sitting on, So the scary one for me is a little bit earlier this morning, I worked out in 30 years time, if I had 6 million.
No, you can't keep us suspended on this. I have to know the answer. He's doing it on purpose now, I think.
Connie, I can't help you because I have no idea what he was going to say.
I'm like, I have to know the answer. Okay, well, that'll be like a cliffhanger for the end of the session. Candice, maybe you can answer this question. What kind of performance or percentage annual return should one aim for? Like, what is a good benchmark, or what's a good return to look for in an RA or a TFSA?
So the simple answer is the most you can get. But remember, there are restrictions. So you're in those Reg 28 funds, so you only have 70% in equity. So you're probably looking for consistently somewhere between 6 and 8% per annum. So remember, in the stock market, your returns don't come in a straight line. So you can have 5 bad years and get all the performance in kind of the 6th year. And in fact, we've just lived through that experience. The 5 years up to last year, surprisingly up to COVID, the performance wasn't great. Performance was probably in the region of 4% per year in those balanced funds. And from sort of the beginning of lockdown to now, you've made up all the returns that you deserve for having sat through that time, but you've made it up in 1 year. So again, it's time in the market, not chopping and changing, and choosing the fund carefully up front. So it comes back to Craig's point about go and look where your employee's pension fund is invested and don't leave it in a money market. You do need some of those risk assets.
Okay, we've only got a few more minutes left, guys, so we're going to try and get to some juicy questions, but we'll also have this recording up and we'll try and get to your other questions as well. But I'm just going to try and pick a last few. Hi, guys, Lita here. Hello, Lita. Can I move my RA from one company to another, SATRIX? And if so, how long does that process take?
So you can definitely do that. It's what's called a Section 14 transfer. And the reason it has such a fancy name is because the trustees of each of the funds need to talk to each other. The process can take very long. So the thing that you need to check is that your funds, your underlying funds are not out of the market. So once you start the process, you make sure that your money isn't disinvested from the market and put in a money market fund until it is moved to the new provider. But otherwise, there's really no sort of downside to moving it, especially if you're moving it for better investment options and for better fees.
Okay, cool. Let's take one last question. This is quite a long question, so I'll try my best here. I'd like to invest in, it looks like pounds, dollars, euros. How is this possible? I'm 49, I have another 10 years of saving. I'm currently saving 1,000 Rand a month in my RA and 2,000 in tax-free. Which funds do I need to invest in? I was in the local markets when they didn't perform well. I moved to the world and emerging markets. Now they're not doing well. Should I move to another fund? I want to teach my son, he is 10, how markets and funds work, so he'll be prepared for future savings. Do you have a guide or any information available? So a lot of questions there.
Okay.
But I think maybe the ones we could pick out are, how do you get global exposure? Is that possible in an RA or not? And then also just in terms of, how do you know which funds to pick? How do you best arm yourself to answer that question?
Okay, so yes, you can invest in offshore currencies in South Africa in SATRIX ETFs. So they are known as Rand-denominated offshore funds. That's a mouthful, but it's all in the name. They're denominated in Rands, but they are offshore. So you put your Rands into, for example, the SATRIX MSCI World ETF. The money is invested offshore in dollars in offshore companies, but you get the returns back in Rands and you get the growth of the global companies. So SATRIX has 8 or 9 global ETFs. They're all investing in different regions. So you need to go and have a look. There's the NASDAQ, there's the MSCI, there's China, there's emerging markets, there's ESG, the environmental, social, and governance ETFs for the greenies. On the SATRIX website, you can go look at the fund fact sheets and they will explain exactly where those investments are invested. So you can definitely get global exposure in your tax-free account. There is global exposure in your retirement plan if you're picking one of those 2 funds. And then just to touch on a point, once again, about watching performance far too closely. I think the question was that I was in offshore and now it's not doing so well. Well, the Rand has strengthened precipitously. The Rand hasn't been this strong since February.
Maybe it's me, guys. Maybe.
The underlying investments are still great. Invest some into the local market, invest some into the offshore market, and just keep chipping away with that debit order.
So consistency, that's really what you need to be focused on. Just get in there, be consistent, stay the course, keep a long-term point of view in mind.
And don't chase performance. When something goes down, it's probably going to turn around. Just sit tight.
Okay, guys, so I think we're going to wrap things up there. If you had a question that we didn't get to, or you haven't quite sent your question yet, I think we've got an email address that you can send questions to, and we'll make sure that we try and answer those and get some communication back to you on that. But Candice and Craig, he stood us up, but I mean, I'm sure he was very happy to be here. And thank you so much for joining us and sharing your insights. It's been awesome. I've learned so much. I'm going to go and do things now. I'm going to go and make some investment choices. Thank you, everybody. Thanks so much for joining.
Bye-bye.
Bye.